everyone. Welcome to our Charts Are Fun weekly session. This is for the week of September 16th, recording this after market close on September 20th. Exciting times. Market loved the Chair Powell's decision to do an interest rate cut of 50 basis points. Market, as we had shared on the FedWatch CME tool, had already started projecting that. There was a high probability of over 65% of a 50 basis point cut, and only a 25 basis point was only about 35 or so. So market got what it wanted, rejoiced at it. Initially, it pulled back, as in after the press conference on Wednesday. The market kind of, after the initial spike, started pulling back. But then overnight, thought over it, digested the news, and then Thursday took off, and today was a slight pullback. So we're going to look at what are the pundits across Wall Street saying. We look at what Tom Lee is saying. We look at what Carley Garner, who has often been in Jim Cramer's shows. She's a commodity trader analyst who writes blogs on Real Money Pro. We'll talk about what her thinking is, and share, another very well-known economist, Komal Sri-Kumar. He was in CNBC today, and what did he share? So we talk about some of that. We're going to look at the charts of S&P 500. We look at, in fact, the next Fed rate decision is on November. So we look at what is the CME tool saying right now. We still got a little over 6 weeks left for that, but we'll see what it is saying now. And then from S&P 500, we look at interest rate sensitive sectors, home builders, and small caps in particular. And then finally, look at Bitcoin. Bitcoin had a pretty good upside move this week, and we'll see where we think that could be headed. So with that, let's share the charts. So this is our website for our blogs, daily blogs, chartsarefun.substack.com. You just have to use your email, and it's a free subscription, and you would get our blogs that come out every morning. And we'd love your comments and see if you have anything to share there. Also, our YouTube site, charts also called Charts Are Fun. It's our channel, youtube.com/@chartsarefun. We appreciate your subscribing to this channel if you haven't already done so. And then if you could hit the like button if you like our videos. This helps us share with a broader audience. So this was the interview today where BMO, this is Bank of Montreal, their key analyst, Brian Belski, he had previously talked about S&P's target towards the high end, but today he and his group issued a report. In fact, they issued it yesterday after the Fed move, so it was issued on Thursday morning, calling for a target at 6,100. We'll see if technically that target makes sense, and we'll see where that matches up with the technical charts. That said, Evercore has got a closer similar to BMO at 6,000. So those are the two that are in the 6,000 level. Oppenheimer 5,900. You could expect these analysts to follow on one after each, kind of beginning to increase their targets on S&P. These are year-end targets, mind you. RBC Capital is 5,700, and a bulk of others, UBS, Goldman Sachs, Citigroup, are at 5,600. Morgan Stanley, we know, has been quite bearish. Their projections are likely lower, maybe towards 5,200. But Mike Wilson, who has always been cautious in the market, recently was at one of these risk reversal videos in YouTube run by the Fast Money crew, Guy Adami and Dan Nathan. And he was kind of cautious on the economy and the fact that there still was a possibility of a recession. He hasn't given up on that. But BMO seemed quite positive. They feel that Fed being accommodative, the 50 basis point cut helps the market with a soft landing and likely makes it coast higher for the remaining few months. Komal Sri-Kumar made a very bold statement that Chair Powell had no option but to do this to keep the market happy. He literally has set up the market now to expect 50 basis points moving forward. He said that starting off back from 2018, when he called Chair Powell a rookie, he had just about joined at that time. Even then, he'd made some kind of miscalculated moves. The market pulled back significantly, and then he kind of backpedaled and then started doing things to satisfy the market. In a similar way, he feels that, yes, he was behind the curve with respect to should have done a cut in July, which he didn't. The labor economy started slowing down, got him concerned. And he basically convinced the other, Fed members to start voting for this 50 basis point cut. Markets FedWatch Tool, of course, had also been signaling that. There was a much higher probability on that, and that kind of, forced Powell's hands. And also the bond market. If you look at where the treasury yields, especially the long-term treasury yields, and in particular the 2-year, which really is where call it the neutral rate is supposed to be, is more measured by where the 2-year rate is. The 2-year rate was near 3.55 before the Fed rate decision, just quite far off from where the interest rates were, which is at over 5.35. That's kind of the widest margin of 180 basis points of where the Fed rate fund rate were to where the 2-year yields was. So that was an indication from the bond market that, look, think the interest rates need to come down. And Powell had no option but just to follow the markets, take a lead, and then kind of do what Komal Sri-Kumar is saying, kind of satisfy and please the market. Tom Lee did say that he feels that those that were in the hard landing camp will start realizing that it's not a hard landing with Fed's 50 basis point cut. They should, and they probably will start moving into the cyclical sectors, things that would directly benefit from interest rates coming lower. He talked about the small caps being the beneficiaries. He talked about financials and in particular the industrials. He felt that these 3 sectors would be beneficiaries of money moving in and kind of continuing their rallies. That was his point, though he did say that during this time period in election years, September, October tend to be volatile, tend to be unpredictable. So he wouldn't just, close his eyes and jump into the market. His point was that be a bit cautious, maybe wait for a better entry point, some pullback, and then he continues to see bullish upside. This was a very bearish remark from Carley Garner. As I said, she has been with Jim Cramer's Mad Money in the past. Her charts have often been shared by Jim Cramer in Off the Charts column. She is an active columnist in Real Money Pro, which I subscribe to. And there she talked about, which I have shared in previous blogs and YouTube videos as well, is when you start looking at the inversion, right? When the yield curve, which is 10-year minus the 2-year, inverts, goes into negative territory, and then uninverts and starts steepening. Look at the last 4 time periods that she has drawn up. This is the 2007, the 2000 to 2001 timeframe, and then towards the mid-90s, ignoring the 80s out for the time being. Each and every instance, when that has happened, the market has pulled back. So she's raising a caution. Now, the comparison point is there are folks who are comparing this point to more towards the mid-90s, saying that we could expect to see steepening, but this could be steepening with the market fundamentally. It's like a bullish steepening happening. Economic growth is coming in. As a result, the yield, the difference between the 2-year and the 10-year keeps steepening from the growth part of it. That said, Carley Garner's point of view is this is more like 2007 is what she's worried about. She's saying that 2008 was an election year, 2024 is an election year. 2007, around the August timeframe, she's comparing it to the chart right there. It had topped out in July of 2007, then the market had a sharp pullback in the month of August and then reverted and retested the July high in the September-October timeframe. She's talking about the same right here. We had a July high, the market pulled back sharply in August, reverted back in September, October, retesting that high, in fact, slightly above it. And she feels that this is setting up for pullback like we saw in 2007. She seems also bearish, looking at another red flag, which has to do with the yen carry trade move. She compared that to the chart of the yen right there. And if you look at here as well, in 2007, we had a similar kind of yen carry trade crisis, and the yen had weakened quite a bit, tested that support line, and then from there it sharply turned higher as the market sold off. She's expecting in this case also kind of call it a wedge pattern where the yen just broke out of. This was a shakeout in August when we got the carry trade fear. And she feels that this is only in the second or the third innings of where this carry trade can unravel. Yen can continue to get stronger as we see divergence. We see Bank of Japan beginning to raise rates. Well, here in the US, we have our FOMC decreasing rates. So this differential could at the end make the yen stronger and could have unraveling issues with people who have been borrowing the yen, which is at a much lower, almost to zero rates for a large amount of time, and buying into higher yielding assets. But that could unravel and there could be more risk ahead from that. So that was her point. Let's look at the CME's FedWatch tool. This is already looking into the November meeting. We can see the 7th November meeting. Typically, these happens 6 weeks after. So we just had the meeting of the September meeting this week. 6 weeks later is around early November, 7th November. We already see that there's a higher probability of a 50 basis point cut now at 50.3, was the 25 at 49.7. If the job data, which comes out first week of October, continues to show weakness. We already know that the 3-year rolling averages of new jobs added has started coming down. We're right now closer to the 116,000 3-year rolling average of new jobs. We know that unemployment briefly dipped from 4.3 to 4.2, but once it crosses 4, many people talk about the sum rule, and the rolling average of the unemployment goes up over 0.5%. Often it's an indicator of a recession, and we know that that has gone up. I mean, from what was around closer to 3.4% towards like the April timeframe last year, it was as high as 4.3 in July. In August, it briefly dipped to 4.2, but we could see a resumption of that unemployment. So that is a bit of a concern, and this could then mean that the FedWatch tool on the 50 basis point could start even going higher. And as Komal Sri-Kumar said today, once the market, you whet their appetite expecting 50 basis, they're not going to be happy if Fed then turns around and does a 25 in November. He thinks that market will put pressure on Fed to start doing a 50 again in November. So that's something to look at. That said, something that matches with Carley Garner's expectation is the VIX chart. This is a key pattern. Similar to late 2021, we saw a silver cross of the VIX weekly chart where the 20-week moving average in red went above the 50-week moving average in blue. That cross, once it happened, put VIX in an upper range, trading from anywhere from 18 in the low to up to 38. We could be setting up for a similar situation. Notice that we had a very big spike in VIX on the yen carry trade Japan crash in August 5th to 65 pullback, but holding higher lows. We can see that. And we see that this same silver cross of the 20-week above the 50 happened recently, like it happened back in late 2021. We know 22 was a bearish cyclical bear market. So we could be, if Carley's perspective may not get as fast, as deep a correction as 2007, but can't rule out cyclical bear market, some form of a 10 to 15% to even 20% correction over the next several months. Carley feels that the election results could be the trigger. We don't know what could be the trigger. It could be some form of economic reasons of maybe the soft landing may not pan out and we end up getting recession after all. But that said, similar patterns of PPO trending higher in the late 21 into 22, and we see that same pattern here. While VIX, had lower highs, lower lows till the point of 2024, and from there we can see that the PPO is setting up higher lows, and so is VIX. I mean, from 11, forget that transient 10.6 pullback in July, but that was when the market peaked, and from there we see how it reversed higher, and we're seeing a pattern of higher lows in VIX. Also holding on to the 50 level on the RSI. All this indicates that if VIX tends to be upward trending now and staying now again in the 16 to the 38 level, or 18 to the 38 level, like it did in 2022, we could be setting up for a similar kind of a cyclical bear market in 2025. That said, we wanted to look at what was the projected target on S&P from its weekly 3-year chart. A classic cup and handle, 46.37 at the left brim, pull back to 34.91 at the base of the cup, the right brim at 46.07. This is a beautiful cup. The handle formed from there from 46.07 to 41.03. This is a late 23 move at October bottom, and then it is taken off. The measured target on this cup and handle is take the right brim 46.07, subtract it from the 34.91. That measures to a target near 57.23. And we got very close to that within 10 points. It exceeded that by 10 points, and we got a 57.33 this week on market rejoicing Powell's decision. Look at the negative divergence in RSI. As S&P has been climbing in the recent last 3 months, RSI has been printing lower highs. That is typically a leading pattern of a market topping pattern. So before a market tops, RSI tends to print lower highs. So this is a concern. This is potentially a possibility that if RSI is printing lower highs, weakening momentum, we see lower highs in PPO as well. we could perhaps be set up having met the cup and handle weekly target of 57.23 for a pullback. That pullback typically would go back and close towards the 50-week moving average near 5,077. But, a first point to test would be the August lows at 51.19, the August 5th low. That's something to be looked at. Bulls would, however, say that if you look at the daily chart of S&P, the previous one was the weekly chart where we showed a cup and handle target 57.23 that was met. Bulls would say, well, this looks just another bullish cup and handle breakout. So here in the the springtime from April to the May, we had a beautiful cup, the handle, and then S&P broke out. They would say, well, a similar cup has formed from 56.69 to 51.19 back to 56.51. A pullback on the handle to 5,400 and a breakout. We got the breakout this week. They would say that, yes, the negative divergence was there on the daily chart, but now if we can get RSI break up to higher highs from this negative divergence level, same thing with PPO, continue its climb and break up to higher highs, then the negative divergence is invalidated. It's no longer a valid pattern. And we can see that there was a bearish cross of the 20-day below the 50, the red going below the blue, but then it has since then bullishly crossed back higher. And if that continues climbing, this pattern on this new cup and handle over the July-August timeframe measures to a target closer to 62.19. Where did we get 62.19? This 56.69 and 51.19, you're talking about 550 point. At the 550 point to 56.69, that measures to 62.19. So there's a possibility that if this cup and handle pattern pans out, that's the target that S&P could go to. And that matches very close to the BMO's target that Brian put out yesterday. He and his team put out a target of S&P near 6,100. So that can't be ruled out if the bulls are correct in this. That said, let's look at small caps. This is something that Tom Lee has been extremely bullish. This, in many ways, had a little bit of a sharper pullback on the handle. So from 228, it had pulled back to 196, back to 222. The handle pullback came up to 204, and then it's broken up higher above the 222. This is a higher RSI, a higher PPO from the previous PPO. If this trend, and this also had a bearish cross of the moving averages and now has crushed bullishly back up. If this move happens from 196 to 222, that's 26 points. To 26 points to 222 is 248. So that's a minimum target these small caps could be headed to, and something we should look at over the next several weeks. While there's seasonality, while many fear that market would be kind of negatively aligned over the next several weeks, at least till the elections late October, we have to see if this turns out that the market continues to get its bullish move and small caps can move higher to 248. That's something to look at. Home builders are also beneficiaries of decreasing rates, a very interest rate sensitive sector. This had a cup and handle from 121 to 104, back to the 120, a handle pullback from there to 109. That breakout measures to a target near 136. It has touched a higher RSI from the previous RSI. If that's good, that's bullish. PPO is at a higher high from here, so that's also bullish. So there isn't any negative divergence on RSI or PPO at this point because we have a higher high in PPO and a higher high in RSI. We got to see. Today it did have a pullback of 2.2%, primarily because of Lennar. Lennar's earnings was yesterday almost got hit by $9. The stock fell down close to 2 or 3%, 4% drop. And that helped brought these home builders down with it. But we got to see if the small caps and home builders both have individual cup and handles. If they have some more upside, then potentially that could take the market some more higher. The next thing to look at is Bitcoin. The Bitcoin, if you look at, is yet again right at the 200-day moving average, which from a very long term, this is the daily chart of Bitcoin, that is beginning to plateau and start beginning to maybe come down. So this is something to be watched about. Will it be able to take out the 200 now and move higher, or will it fail here? In here in particular is a pattern of lower highs. We got somewhere near 73K in the March timeframe, 72K in May, 71.9, 70K in July, 65.1, and now it failed around 64K. So it's been a pattern of lower highs. So if you look at the pattern plotted out with some form of a pennant shape, in this case, lower highs joining a trend line and higher lows joining a trend line, this will have some form of resolution. Bulls would look for this to break above this pennant, above this declining trend of lower highs. Also, from a daily chart, the 200-day moving average is right here, right? The 200-day moving average is near 64,000. It did cross above it, but then closed below it by the time it closed for today on Friday. It doesn't close. Bitcoin trades 24/7, but when we had last printed this out, it was at 63, right below the 200 days. So that's something to look at over this week and over the next several days. Is Bitcoin going to be able to break this? That would be a bullish sign. That would indicate speculative money. Bitcoin is a big indicator of speculative money, is expecting a bullish continuation of the rally from Powell's 50 basis point. It loves lower interest rates. That's helped the Bitcoins. It could then also mean upside, continued upside for small caps and home builders, something to look at. The key thing in here, which is bullish for the bulls, is the accumulation distribution. Look at the big climb. Since the early September, while Bitcoin has been climbing, it has been climbing with AD hitting higher highs. In fact, to the point where AD is now at similar levels or even higher than it saw back in May. That's a bullish sign. That means smart money accumulating Bitcoin over the last couple of weeks. This could mean that there's a good chance, looking at the AD, that we could get that breakout. I'm looking for the bullish breakout. We'll see what ends up happening in the market. With that, appreciate you joining the video. Thanks for your time. Look forward to next week, and good luck in the markets.